Hello, it's Joshua with another edition of Mortgage Clarity. And this is the fourth video in a series of videos about different news headlines that are trying to paint the picture that maybe the housing market is weakening. And so I want to do this series here to kind of bring the full truth to it, because a lot of times news, they just give headlines, and unless you read the full article, you may not actually get the headline can be misleading. And sometimes the news just simply gets it wrong. So we're going through a 4-part series. If you haven't seen the other ones, you check those out as well. If you like this video, be sure to hit the like button. And if you want to be alerted to the other videos coming in the future, be sure to subscribe. So the topic of today, and this is going to be, I think, a really good one here, is the news says homes are not affordable. And this is one reason why they think the housing market is maybe set for a correction, because it's no longer affordable. Now, before we get going in the slides, I want to talk about what affordability means. This is really important because it's different. I mean, what does that mean? Well, from a general standpoint, we would say that if you're a person's gross income, if 30% of that gross monthly income can support their housing costs, that would be either your mortgage payment or your rent payment, then the home is affordable or the housing is affordable. As you drop below 30% of your gross monthly income, we would say that it's becoming more and more affordable as a rule. And if you go over 30%, we would say housing is becoming less and less affordable. Okay, so that's our baseline when we go through the video. Now, again, that's just a general term, because the reality of this is it depends on each individual person. If you make $10,000 a month and use 30% of your income, the amount of money you have left over to cover gas, food, and medical, 3 things that we all need as well, that's a very different picture than somebody who's making $3,000 a month using 30% of their income for housing. They just don't have as much money left over for the basic needs. And so affordability is not just about that 30%. Again, we got to look at case by case. And some particular borrowers know that they might have other expenses that aren't common, that they know they have to have, that needs to be taken into account as well. But let's go ahead and start with the 30 as the standard for our discussion of, is the news right that homes are becoming more or less affordable, and to the point to where they just simply are not affordable at all? Okay, so let's dig in. This video is going to require a little bit of numbers here, but let's start with some graphs and talk about what's happened. Because you cannot look at home prices by themselves and say because home prices are higher, that means affordability must be higher. So here we go back to 2006, pre-housing bubble, back when rates on average were about 6.75%. Now, typically when rates are being quoted online or by the news, it includes some additional cost called discount fee, where you're buying down the rate. And typically it's about a 1.5% cost. So on average, rates were 6.75% at that peak. During this time though, while home prices continued to go up, you'll see that interest rates actually went down. So home prices went up 53%, but as of about 3 weeks ago when I did this slide here, 4.72%. Again, now this is not a quote for a rate. This is just the average rate where a person is paying about 1.5% to buy down that rate on this day. For an actual rate quote, be sure to reach out to your lender. Okay, so we know then that we got to look at what rates are doing, because even though values are going up, if my rate's going down, what's happening with my payment? Now, the other thing we want to look at, though, is income. So what's happening to income during the same time that the home prices are going up, but rates were going down? Well, let's take a look. In 2006, back there when home values and rates were values were lower, rates were higher, average earning was $20 per hour. Fast forward today, over this time, we see that during this time, the average homeowner's earnings have been growing over time. In fact, they're up 63%. So values are up 53%, home values up 63%, but rates are down. So let's look at the next chart here. So what does this look like from a dollars and cents standpoint? So what this chart here is showing you that a 1% rise in your income can actually support like a 5% rise in your monthly housing expense. Here we're looking at mortgages, but this would be the same thing for rents as well. So if a person's income was $5,000 a month, you get a 1% raise, you're now making $5,050 per month. If during that same time, though, the cost of housing went from $1,000 a month, went up 5%, that means your cost of housing is now $1,050. So it's kind of like a 1 to 5 ratio. And the reason for this is because you're not using 100% of your income to qualify for your payment. You're only using a percentage of it. So what we see here is, again, you can see cost of housing go up, but if your income goes up, affordability isn't necessarily changing. Okay, so let's take a truth here and do a side-by-side comparison of 2006 to 2022. Now, this is an oversimplified version with these rates. And again, we're not quoting rates, and we're going to use 100% of the price or the loan amount with no mortgage insurance. We're just going to do a very simple one, but to show you how this looks from a payment standpoint. So in 2006, the consumer was buying a house at $300,000. The rate was 6%. That equated to a monthly payment of $1,800 for principal and interest. Their income at the time qualifying was $6,000. They're using 30% of their income. So it's right at that affordability mark. Fast forward today, if we apply the same types of increases, so increase the value of 53%, go with the rate that we showed there, apply that payment to $2,386. It's definitely more. And this is where the news stops at this point here and says housing is not as affordable because we've simply changed the payment. But they're ignoring that during that same time, 63% rise in income, $9,780. You're now at 24.39%. So housing affordability is actually lower today than it was in 2006 or in this scenario. So the takeaway is this: why housing costs or the cost to own may not be as affordable as it was a year ago when you had lower interest rates, lower purchase prices, and your income hasn't changed that much in this last year. So yeah, it may have been 19% a year ago, but just simply because it's not as cheap as it was a year ago doesn't mean it's not affordable. Affordability is a combination of what the payment is as it relates to value and rate compared to what your income is. You got to look at that and see how that looks as affordability. And of course, most importantly, you need to know how it looks for you as an individual. So I hope this helped you understand a little bit more about affordability, and that when you hear the news simply say that homes aren't affordable, that's not really true. It may not be as affordable, but I think for most people, when we look at what that was in 2006 to today, homes are actually more affordable today. Also look at opportunity. What does it cost to own a home compared to rent? And what's that benefit? And to know more about that, check out my other video about buy versus rent to find out how even though you might be paying more to own, it might actually benefit you a lot more than rent, which might look cheaper on the front. All right, that's it for now. Again, don't forget, like it, hit the like button if you liked it, subscribe if you want to know more information that comes out in the future, and have a fantastic day.